Well, hello, my name's Damian Knoblanche. I'm from the Peak Partnership. We're a firm of financial services out at Mount Gravatt. And Warren and the team have asked me to come along today and just talk a little bit about intergenerational wealth. There's been a certain change in our client base. We look after about 800 small to medium-sized businesses and about 1,800 individuals. And in that database, we have quite a number of people in that 55 plus category. What we're beginning to see is that there are a new generation, a new attitude towards the passing of wealth to the next generation, the X, Z and Zero generation. What we'd like to see is that that's done in a structured way such that they look after themselves but also give a helping hand to either the kids or the grandkids. So where do you start with intergenerational wealth planning? You've got to start with your own circumstances to begin with. Most of us are going to live at least 20 to 25 years in retirement. So we're going to have investments that grow in value as well as produce income. So you'll be well aware of the product that Warren and the team produce at Sentinel, which has dependable monthly income and also the possibility of capital growth in most of those markets as well. So once you've secured your future, you can start to look at what you're going to do with either your excess capital, your excess assets, and how you're going to hand those down to the next generation or even the generation after that. Some of the assets that Warren's acquired recently, particularly Darwin, can be seen as an intergenerational asset, one that you wish to keep in a structure, something potentially like either a superannuation fund or a family trust, where you can continue to pass income and the resultant capital gains down the track onto the family for 1 or 2 generations. So it's a nice way in which you can keep the asset and yet produce the income. If you do have excess cash at this point in time, you'd understand also that term deposit rates are starting to come back, but it's also only part of the picture for you for your planning. So you really need to think about that capital growth. So where can we help you in terms of the intergenerational wealth and particularly commercial or industrial property development investments? What we've considered is that possibly the best thing you can do, as I said, is structure it in such a way that either your initial investment or you can move your current investment across to a family trust or a self-managed super fund. That may incur some transitional costs, such as capital gains tax, but at the moment, with the higher interest rates, that's reducing the amount of what we call the compression rate on the returns in the buildings, and therefore the valuations are down, and this might be an appropriate time to look at that strategy. Once you've done something like that, you have the ability then, as I said, to pass down the income and also the capital of that product, the units and the unit trust that you own and the family trust to future generations. What we're seeing also is that the helping hand that's happening with the bank of mum and dad or the bank of grandpa and grandma is helping those younger generations. And this can be done through the payment of income out of those family trusts or on the realisation of the assets, some of that capital being returned to the other generations. And this is an excellent way in which the fund can be controlled to a certain degree even after your death. No doubt you're well aware of the changes in superannuation and the new $3 million limit and the additional tax that you pay when you have investments above that. We still believe superannuation is an appropriate product to hold investments in, and particularly in the longer term it's the lowest income tax at a 0 rate once you're in pension phase that we have. So don't be concerned or overly concerned about the self-managed superannuation funds owning assets. You do need to get a couple of things in order though. As no doubt our lawyers will be able to tell us shortly, the legal state of where you sit in your superannuation is very much determined by the binding death nominations that you need to produce in your self-managed super funds rather than your will, and also things like advanced health directives and particularly your wills and your wishes and how that wishes to proceed. So we'll hear a little bit more about that shortly. So in summary, if you're trying to look after the kids and trying to look after the grandkids, there are ways in which you can do it, which is both tax effective and smart in relation to the way you want to pass down your wealth and even the gains from the capital assets that you've got. So I'm sure the team here at Sentinel will be more than happy to have a chat to you about the transferring of assets or the taking up of additional units in unit trusts in maybe one of these structures like a family trust or a self-managed superannuation fund.